Tonight in Newsnight Scotland, oil prices have doubled in a matter of months, but are they ever likely to fall? And have we even begun to wake up to the implications of a world in which oil permanently costs more than $100 a barrel? Good evening. Behind all the arguments about fuel duties, vehicle taxes and high petrol prices at the pumps looms a much larger issue. Is the oil running out? Until recently, experts who argued that world oil production either has peaked or is about to peak were generally dismissed as cranks. People remembered the alarmist forecast in the 1970s that oil was finished, which turned out to be nonsense. And indeed tonight a BBC Scotland documentary heard there could be decades more North Sea production yet to come. But while there is oil left, it's getting harder and more expensive to extract. And while prices might fall a little from the recent high of $135 a barrel, the days of cheap oil may be over forever. Kenneth MacDonald reports.
Nearly 500,000 people working in a British industry.
In a magisterial sweep, tonight's documentary encompassed the past, present and future of North Sea oil. Among its findings, the North Sea has almost as much oil left as has already been extracted. But that's the good news. The bad news? It's going to cost you a lot. In Belgium today, fishermen were taking to the streets in protest at fuel prices they say make a mockery of going to sea. On this side of the North Sea, they tend to do things more sedately, but the message from Scotland's farmers to Whitehall was essentially the same. Here at least, they emerged claiming a breakthrough.
I think one of the commitments we got from the Minister today was that she would look into the distribution of fuel in the islands, for example. I think that was a great breakthrough. And I think one of the other roles we had today was to explain the situation as we are facing it as practicing farmers. It's pretty grim out there just now. We're facing a problem coming up of crop planning. We don't know what crops to grow. The crisis is dictating what crops will be growing in the future.
In the 70s, the last time oil multiplied in price in such a short time, it sparked a change in the way we thought about energy. Now the price is many, many times higher. Will it change the way we live?
Quite clearly we're heading for some kind of sea change. Exactly when it happens and how quickly, nobody really knows. But I think we're going to have to focus far more on the energy efficient modes of transport. We're seeing the problems road hauliers are getting into now because 40% of their costs are fuel. So rail freight, use of water transport, these are going to become much more important.
Last week, fishermen in Spain and Portugal made their voices heard. Hauliers in England and Wales were making their protests too. It all underlines the fact that it suddenly got a lot dearer to get things from field and sea and factory to us. Scotland may still be floating in an oil reservoir that's half full rather than half empty, but rising prices are already changing thinking about how to move goods around the country.
Scotland's got a 3,000-mile coastline, so there are plenty of opportunities for developing coastal shipping, which is already a strong mode of transport for freight. But we've also got canal opportunities, not for lots of different types of goods, but things like domestic waste, timber up in the Highlands, possibly moving stone and aggregates from locations which are beside the canal. And perhaps increasingly in the future, we'll be locating manufacturing and processing activities beside canals, beside railways and beside the coast.
There's already been a move off the roads onto rail.
A lot of the blue chip players have moved to rail and are increasingly doing so, the likes of Asda, Marks and Spencer's, the big whisky companies, and there's much more scope to do that. Yes, there's some money needs to be spent on the infrastructure, but the capability is basically there, and we've got very long hauls from Scotland to market, so that suits rail very well. It's the basic commercial economics that if you can get a cheaper run by rail and the service is as good as it is by road haulage, then companies will move to that. There may be some environmental pressures as well, and that partly comes from the government, partly from the sense of corporate social responsibility that some of the bigger companies have. But it's price and service that's basically driving it. But now I think it's much more a case of an insurance policy for the future. Looking ahead, the way oil prices are going, it's crazy to be wholly dependent on one mode of transport, i.e. road haulage.
But there's an important caveat to all this. Things change. After OPEC drove the price of crude to what was, by 70s standards, a stratospheric level, the 80s saw a price crash. Today's conventional wisdom is that increased demand from developing markets like China and India is what's put the price beyond $120 a barrel. But not everyone's convinced.
Pure speculation, in the main. some elements of supply and demand, some elements of the increasing cost of getting oil out of the ground. But if we take those two factors into account, and only those into account, then the $100 a barrel oil should be nearer 35 to 40.
Another school of thought says the rising price of a barrel is the inevitable consequence of peak oil, that the world's maximum output has been reached and is now in terminal decline. The high prices will stay high.
Who knows exactly where all this is going in terms of oil prices? Nobody really knows. But I think the reality is there's a growing body of opinion which says that global oil production is going to peak sooner rather than later. Maybe it's going to be 5 years, maybe 10 years. But even if it's 15 or 20 years, you think of the time it takes to re-gear a transport system to new modes of transport and new patterns of distribution. We need to be making a start now.
High oil prices could present what many would see as an upside for Scotland. There may be another North Sea's worth of oil off the west coast, deeper and more expensive to extract, but made viable by an oil price that's high and stays that way. How we'd square that with a desire to stave off global warming would present an agonising choice, but at least we'd have a choice.
Well, earlier this evening I spoke to Chris Skrebowski. He runs Peak Oil Consulting, which tracks oil production across the globe. I began by asking him if he thought we'd reached peak oil production.
I personally don't think we've actually quite got to the peak, but we're certainly in the foothills. We're certainly finding it, or the world is finding it very difficult to expand production further. And this, of course, is running up against continuing pretty vigorous demand, particularly from the Far East. And the consequence is these very high prices.
How much of the new oil which we are finding each year is, in your estimation, simply going now to replace oil which is going off stream because it's run out?
Well, a pretty high proportion. The best calculation is that due to global depletion, we're losing anywhere between 3 and 4 million barrels a day. Now that sounds a very wide range, but it's actually quite a difficult calculation to do. Simply because there are other factors that impinge, and trying to filter them out is not straightforward. But what that means is that we currently have been bringing on 5-6 million barrels a day of capacity, which means that a large chunk of it is preempted by depletion. You need to do that just to stand still.
Why the pessimism, though? Because isn't it possible there could still be vast new oil fields to be discovered?
That is certainly true. You can never say that there won't be, but there are two things that suggest that that's relatively unlikely. Exploration discovery peaked back in 1965, and with certain wobbles has been in decline ever since, and we're now at the point where we're discovering about 1 barrel for every 3 that we consume. So we've been, in effect, consuming more than we've been finding since about the mid-1980s. So we've been clearing out the storehouse, if you like, of past discovery. We're not entirely there yet, but what is available is thinning right down.
Right, but some people would argue part of the problem is political rather than geological, if you like. There are large areas of the world which Western or Western-style oil corporations don't have access to with their technology and their expertise. I mean, you can rule them off: Iraq, Iran, Saudi Arabia, even Russia, obviously.
Certainly, but the judgment you've got to make is whether there is any realistic possibility of these policies changing. And if you think that there isn't a realistic chance of the policies changing, then it becomes exactly as fundamental as physically not having it in place.
Now, there's much talk, actually in connection with the North Sea as much as anything else, about how we could get more oil out of existing fields or exploit pockets of oil which are as yet unexploited. Now, it doesn't quite work as simply as that, does it? And I know you've got an example from East Texas. Just tell us about that, would you?
Certainly. In effect, you can always make an oil field last a bit longer. Many of them have been in production for a very long time. The biggest field found in the main southern states of America, i.e. excluding Alaska, was the East Texas field, which was found in 1930. At that point it was flowing 100,000 barrels a day of pure oil. Now these days it's still flowing, it's still in business, it's still producing towards 100,000 barrels a day. It's just that 99,000 of them are water. So it's actually producing about 1,000 barrels a day of oil, which is very nice to have. You know, if it's yours, it will make you very useful money. But if you're seeking to meet a world demand, it's not desperately useful. And
right. Now, how would you reply to the objection to this whole peak oil theory? People say, well, look, no, what happens is still a function of the oil price, not of barrels of oil that are actually in the ground. And the very fact that oil prices are now high will mean that we become more efficient the way we use motors and all the rest of it. And eventually the price will drop, or the high price will itself encourage new exploration and production, because things that weren't profitable to do at a lower price are profitable now.
Well, I think there's two elements there. If we look at the production side, it is certainly true that you can do things at $150 that you can't do at $30. However, the nature of oil fields is such that all these increments come out very slowly, so you're only adding marginally to your production. It's very difficult to establish really substantial flows. I mean, even something that appears to be a wonderful resource, like the Canadian tar sands, well, the Canadian tar sands, they hope, will expand by 3 million barrels a day by 2015 or 2018. Now, that won't even cover 1 year's global depletion.
Okay. Now, look, we're running out of time, so just very briefly, how do we explain the recent rise in oil prices? Because what a lot of people are saying is, look, yes, we've got all these factors like increasing demand in China and India and all the rest of it, but that's not something that's happened over the past year. That's something that's been happening for 10 years or more. In fact, demand in China apparently has leveled off recently. It doesn't explain why oil prices have doubled within the space of 12 months.
No, the explanation for the doubling in 12 months is in fact the quality of the oil that we've got available. What the Western world what the world increasingly wants are middle distillates, particularly diesel and particularly jet kerosene. So you want crudes that are rich in these. So we have the paradox that we're bidding up the price of the light sweet crudes, the easy to refine crudes that give good yields of this, to very high levels, at the same time as the Iranians are having to store some rather unsatisfactory crudes in ships because no one wants to buy it.
All right, we'll have to leave it there. Look, Chris Skrebowski, thank you very much indeed. Well, I'm joined now from Aberdeen by Euan Mearns, a trained geochemist. He ran an oil service company from 1991 to 2002 and now writes for the energy website discussion forum, The Oil Drum. And in our Edinburgh studio is the executive editor of the Scotsman, Bill Jimison. Euan Mearns, do you agree with Chris Skrebowski that there is something more going on here than an oil price spike which can be sorted out by the normal laws of supply and demand?
Good evening, Gordon. Yes, I'm very much in agreement with most of what Chris had to say. I guess the one correction I would make to that is that Chris said that we were in the foothills of this peak. I would suggest that we're actually pretty far up the slope and should be very concerned about future oil supplies.
Right. Now, why do you say that? Because it does seem fairly clear that we are still discovering each year more than enough oil to replace what we're using in the previous year. And we still do have substantial reserves, and we've had all this talk about, with new technology, all the extra reserves you can get, not just from the North Sea, but other places around the world. So what's the basis for saying that?
If you look just at structurally how the oil supply side has evolved, one of the first big changes took place in 2004. Prior to that time, the OPEC countries always had what we call spare capacity. So these were wells and fields that they weren't actually producing. This spare capacity was production that they were withholding from global supplies to actually support prices. And what happened in 2004 is that OPEC's spare capacity basically fell to zero. And what that meant is that when the world wanted to demand more oil, and there is a high demand for oil, that prior to 2004, all that had to happen was OPEC just had to turn on a few taps and bring on a few new wells that they had sitting idle. But since 2004, they've quite simply not been able to do that.
OK. Bill Jimison, are you as worried?
There is a paradox here, which we haven't really touched on, and that's why it is that the oil price has exploded 60% in such a short time since the start of the year. And it's the, if you like, it's the angle of ascent that cannot be explained by the China story. We've known about China for, you know, five to 10
sure,
years.
But did you presumably heard what Chris Skrebowski's argument? His was that actually what's spiking is the demand for light crude, that the Iranians still have fuel oil lying in tankers off their shore because they can't sell it.
Well, if you look at the prices in New York and London, they both spiked at or around $136 about 10 days ago. Interestingly, the price has come down about $11 since then. That's quite a sharp fall, 9% in 10 days, which does rather lend credence to the suspicion that there is quite a speculative element in the rise that we've seen over the past 3 months.
Yes, but of course the people who argue against that view say if there really was speculation, you'd expect to find evidence of hoarding. And there just isn't any. Inventories, both national inventories and private sector inventories, have not gone up.
Well, a lot of the trading in recent months has been in the futures market. It's been quite a colossal explosion in the extent of futures trading. It's more than trebled in less than 2 years to, I think, about $235 billion. Very interesting.
Right, look,
no, just one point, if I can make. Very interesting. Last week, the New York Commodities Exchange launched an investigation into what has been going on in the futures market.
All right, let's not get bogged down in the details of the futures market, but what the argument against that is that actually the way the futures market works actually encourages people to put oil onto the spot market, not to withdraw it from the spot market. Therefore, it doesn't matter if there's been a huge explosion in futures trading. It cannot account for the increase in the oil price now.
Well, there's a lot of points that Euan said which I'd fully agree with. I do think we have a problem medium term, but it's very interesting that we've seen right round the world an immediate pullback in, if you like, oil consumption. Oil consumption in America last week fell by about 4%. We had warnings only today from the OECD about a real slowdown in the economies of America and the Eurozone. And I think you will find that there will be a huge pressure on demand, and we will adapt to this. We will adapt to this.
Euan Mearns, I think we're now up to, I'm counting the number of theories we've got of why the oil price has gone up so much in the last year. I think we're on, if you could offer us one, number 4.
Well, I actually just like to pick up on the point there that Bill made about demand is falling, and that's very true, and this is how the market supply and demand dynamic works. And what's actually happening is that poor people throughout the poor countries of the world and throughout the OECD are essentially being priced out of the market.
Yes, but it's more than that, isn't it? I mean, as Bill was saying, it was in America. I mean, look at what happened yesterday. General Motors comes out and says, we're shutting 4 truck plants, we're going to make small cars, we're going to possibly sell Hummers because we can't see a future on it at this oil price. Now, the argument would be that's exactly the way the market's supposed to work. Prices go up, and we do, as we did in the 1970s, we consume less oil per extra unit of economic growth that we produce.
Yeah, I certainly see that. There will be a lot of adaptation. The question is whether the best route here is to allow the market to dictate everything, or whether the government should actually be somewhat more proactive in identifying the problem that we have and setting in place infrastructure projects to actually deal with it. The government is involved in road building and expanding airports, whilst every day we hear stories of airlines that are going out of business because of the escalating cost of fuel.
All right, we're now veering into a completely different area of discussion, so we'll leave it there. Thank you both very much indeed for joining us.